The second talk is about, what are the consequences of inflation, or why is inflation bad? In the first talk, you were able to make some sense of what causes inflation. But why is inflation bad? Why is inflation bad? Yeah.
Stuff becomes more expensive.
Thanks for giving me the wrong answer. You walked right into my trap. Right? The fact that things, I just needed one wrong answer. There's just one wrong answer. Akash, you cannot outdo the wrong answer.
It distorts the prices.
You can't keep doing this to me. You did this in the first talk. You are stealing my thunder. Right? Okay. Let me get started with the wrong answer, which is stuff becomes more expensive. Okay. From an economic point of view, stuff becoming more expensive is not a cost of inflation. Right? Note where we started from. Inflation occurs because the government, by instructing the central bank, prints more money. Naturally, prices go up, which means that you can buy less of real goods and services, but the government can buy more of real goods and services. Society as a whole, which includes the government also, has just experienced a transfer of resources from you to the government. Now, government of course is ultimately you and me and some other people. So really this is just a way of transferring wealth from one group of people to another group of people. Okay. Does inflation destroy wealth? Possibly, but that's a more complicated topic which we will not speak about today. But if you presume inflation does not, it does destroy wealth, but we'll come to that more. But but for the moment, if you leave that question aside, right, stuff getting more expensive is not a cost of inflation. Okay. Think of people. So for instance, people when elections come, people say, politicians come and say, hey, what do you want? People say, we want free education. Right? You print money, it becomes more costly to buy food, but you get free schools. It is true that you can afford less food now, but you're able to have more education. Right? Okay. So the fact that some things have become more expensive is not a cost of inflation. Okay. Right? So the vast majority of the general public, if you ask them, why is inflation bad? Why do you not want inflation? Their answer would be, things are becoming too expensive. We don't want things to be more expensive, and therefore we don't want inflation. Okay, but from an economic point of view, that's not a cost of inflation. Right? Because this same very public, if we actually reduce the supply of money, indeed certain goods will become cheaper than otherwise, but they also will not be able to get their free education or free health or whatever else, because government just doesn't have the funds for this. So the only thing the government is doing by printing money is changing your consumption basket. You get less of something and you get more of something else, which they have promised in the electoral cycle and which you have demanded in the electoral cycle. So you go away from the production of goods and services via markets to the production of goods and services via the political mechanism. So you go away from the production of goods and services in the economic mechanism to the political mechanism. That's the only thing that has happened. Okay, right? Okay, so that is not a cost of inflation. The real cost of inflation, in fact, again goes to what, Adnan? Adnan, is that your name? Real cost of inflation, right, has to do with what is called the distortion of prices. Okay? Distortion of relative prices. Okay. So now we have to move far away from the equation of exchange and quantitative theory of money that I wrote down earlier, because that had to do with the average price level. Now we have to go far from that to a world in which relative prices, the prices of different goods and how they relate to each other, matters. Okay. So before we get started, right, let us try to, before we get sort of into the details of how inflation affects relative prices and why that matters and how that destroys wealth in society and how that has a damaging effect on economic growth, right, let me actually get started with something much simpler, which is the function of relative prices in an economy. What do prices do? What do prices do? Okay. Consider the world economy as we exist today. Okay. Billions of people producing many different commodities, all cooperating with each other. Consider the iPhone. Okay. A fair number of metals go into making the iPhone. Okay. Many of these metals are not produced in the United States. Right? In fact, there is no single country which produces all the metals that go into making the iPhone. There are numerous people spread around various different locations, many of whom do not know each other, some of whom do not like each other, right? All contributing and benefiting from the production of an iPhone. Okay. How does all of this work? Do the people who run Apple, call everyone who's involved in the making of iPhones and say, here is what you need to do? No. Lots of this coordination happens through the price mechanism. Let me give you a simple example. Suppose a coal mine is discovered in Brazil. Suppose a coal mine is discovered in Brazil. Right? Now we have more coal. Humanity as a whole has more coal. Okay. Now we should all be using more coal and less of coal substitutes. It's rational for us to use more coal and less of coal substitutes. One way this can happen is that the person who's discovered coal in Brazil, right, picks up the phone, calls Akash and calls me and calls Adnan. No, what's your name? Adnan. I should have taken the medicine in the morning, I really should have. But right, calls Adnan and says, hey, you use, why don't you use more coal and less of coal substitutes, right? And he makes all these phone calls around the world. Such phone calls are not made. In fact, he doesn't even know Adnan, Akash and me. Okay. Here is what he does. He picks up the phone and he just calls up the exchange where coal is bought and sold and says, look, we have more coal and I would like to sell so many tons of coal. As soon as he sells those tons of coal, what happens to the price of coal? Goes down. As soon as there is a decline in the price of coal, right, everyone around the world who uses coal decides to use more coal and less of coal substitutes. Okay. There are people in the Scottish Highlands, right, who stop rearing sheep. Why? Because you don't need as much wool anymore. You can keep your home interiors warmer by just burning more coal. You release resources which were used for rearing sheep, right? Which is land, which is people who were rearing sheep, right? What happens next? What happens to that land now? Right? Possibly it becomes a tourist location. Possibly the prices of hotels in that area declines because sheep rearing area has now been converted into hotels, right? That would lead to other price changes. You need more concrete, possibly more wood to make these hotels. Wood prices go up, right? Wood gets, there are some places where wood was used earlier, perhaps for heating homes, right? People stop using wood for heating homes, partly because coal is a cheaper good, partly also because wood prices have gone up because people are building hotels. You see, a whole sequence of events unfolds, right? And happens around the world. In fact, it is well possible that the price of aloo paratha here, right here in Hoskas, changes because a coal mine has been discovered in Brazil.
Lamb prices will also go down.
Lamb prices may go down. Lamb prices may go down, right? At least immediately, because there is all this sheep, you don't want them for wool, right? You may send them to the slaughterhouses. Whether it would go down in the longer scheme of things, not clear. Maybe, maybe not, but immediately, yes, right? And people start purchasing more lamb, they might purchase less chicken. Right? All kinds of changes occur through the economy because a coal mine has been discovered in Brazil. And none of this because of explicit sort of direction from one human being to the other, but merely by the working of this price system. Okay. Now, there are of course a wide variety of goods that are produced in the economy, right? And there are three things in essence which determine what are the goods and services produced in an economy. Okay. Entrepreneurs would hate to hear this because they always say entrepreneurship is important, creativity is important. All that is true. But at a very basic, bare level, there are three things that determine what are the goods and services produced in the economy. The first thing is the preferences of people. Okay. Each of you has some preference for consuming certain goods, right? And all these different individuals in the world have different preferences for consuming different goods. That plays a big role in determining what kinds of goods are produced in an economy. Second, technology. Okay, what are the different technologies that exist in the world? Okay, that by and large determines what kinds of goods are used to produce what kinds of goods. T-shirts can be produced in many ways. right? Vineet might like, black cotton t-shirts, but there are multiple ways to produce black cotton t-shirts. There are multiple ways to produce the inputs that are used to produce black cotton t-shirts. There are multiple ways to produce the dye that is used to make black cotton t-shirts. There are multiple ways to produce the inputs that are used to make the dye that is used to make the black cotton t-shirts. As to what is used, right, is partly driven by technologies that exist. Okay. Ideally, you want the production of goods and services in an economy to be reflective of the distribution of technologies amongst different people and the distribution of preferences amongst different people. Okay. Okay. This is what economists mean when they say, right, the production of real goods and services should be driven by real factors as distinct from monetary factors. Real factors. Okay. Some economists may add to this list the availability of different resources, like the discovery of a coal mine. So we've discovered new resources, right? So the changes in prices and the changes in production that happens around the world because of discovery of a coal mine is desirable. We are responding to changes in real factors. Suppose, for instance, there is a sizable, suppose people's preferences change such that they like to travel more than they did before. That too would cause changes in relative prices. Right? The first step would be that you would demand more airline services, so airline ticket prices would go up. Right? The expansion in supply might take some time. The immediate effect would be an increase in airline ticket prices. Airline services become more profitable. Right? They would increase the demand for stewards. Right? They would increase demand for fuel. Those prices would go up. As these prices go up, people would say, hey, this is an exciting sector to be in. It's more profitable than we thought otherwise. They would enter that sector, right? And tourism and travel would expand, right? Some months go by and then you see that because your preference for travel has increased, the industry which caters to this has expanded. Again, not because anyone made a phone call, but merely because of working of the price system. So ideally, we want relative price changes to reflect real forces. Real forces, changes in preference, changes in technologies, discovery of new resources, and so on and so forth. Okay. The problem with inflation is that it alters relative prices, although there has been no change in preferences, technologies, or resources. Okay. And by altering relative prices, it misdirects production. Let me give you an example. Suppose the same person who discovered a coal mine. Suppose the same person who discovered a coal mine, right? Take a different person. Huh? No. That's a good way to kind of do the first thing. Suppose this person, there is his brother who uses coal. So this is the person who supplies coal. He has an evil twin brother who uses coal. Okay, and this evil twin brother somehow is related to the central bank, and they print a truckload of money, and he gets a truckload of money, and for some reason he likes coal, so he goes ahead and spends his money and purchases coal. Coal prices go up, right? And this is going to generate a whole sequence of changes that unfold in the economy. Right? Coal prices go up, meaning what are people going to perceive this as? Coal has become more expensive. Right? We should use less coal and more of coal substitutes. So we must rear more sheep. People in the Scottish Highlands now start rearing more sheep. Right? They buy more land to rear more sheep. There are some hotels, maybe they get rid of the hotels. Maybe they break the hotels because we want to rear sheep. Right? There were some vineyards. They decide to get rid of the vineyards if we want to rear more sheep. Maybe they even start training people to rear sheep. People who are actually picking grapes in the vineyards, they don't know how to rear sheep, but let's start a training program. Okay, and they start training these people to rear sheep. Now note, nothing has changed in terms of real resources, nothing has changed in terms of people's preferences, nothing has changed in terms of technologies. But the production of goods and services in the economy is beginning to change. And for all the reasons I mentioned earlier, this change is not limited to the wool industry in the Scottish Highlands. It's going to spread throughout the world. It is going to affect the price of paranthas here in Hoskas and the quantity of paranthas that is produced. Prices are important because they influence the quantities of goods and services that are produced, not in and of themselves. Okay, as parantha prices here goes up, people may start producing more paranthas, right? And there is a decrease in the production of other goods and services. Why is this a problem? This is a problem for the following reason. This is a temporary effect. It's a temporary because the money has been injected in the economy, and it so happened that this has been injected as demand for coal because the person who got the money first, the only thing he likes to do is to purchase coal. He is not going to get this money next month again. Next month his demand for coal is just what it was before the injection of money, which means what is going to happen to the price of coal next month? It's going to drop. Maybe it's not next month, maybe it's next year. Maybe he gets this injection, maybe it's every year that he decides to go purchase coal. So he's purchased coal, he's missignaled this year. Next year, turns out that he doesn't get the injection of money, he doesn't have a new demand for coal, coal prices go back to what they were. What do you think will happen in the Scottish Highlands now? They have way too many sheep. They have trained way too many people to produce wool. They have drawn too many people away from picking grapes. Right? They have broken too many hotels, and so on and so forth for everyone else in the economy. Now, if you could go back to doing things as before at zero cost, no problem. If there could be instantaneous adjustment at zero cost, no problem. But there cannot be. Of course, there is still a problem, but that problem is too difficult. It would require a full course. But many problems, in fact, require full courses. But I'll come to you. But some of these changes were costly. The hotels you broke down, you cannot just bring back that structure. You can build it again, but it's costly. The people you trained in rearing sheep now, all the resources, real resources that you spend in doing, and what are the real resources? Remember, investment and consumption are two things that you can do with real resources. When you do more of one, you do less of the other. So in training these people to rear sheep, you probably had to reduce your consumption, right? Why did you reduce your consumption? Because you were expecting returns in the future. Now these returns cannot be realized anymore. You have lost out. Okay, right? So the real cost of inflation is the fact that it causes relative prices to deviate from what economists would call general equilibrium prices or steady state prices. And this deviation of prices causes production to be misdirected into areas that are unsustainable. And one way to visualize this is think about the flow of money. As it flows, it's changing prices, okay? It's changing production levels, right? At some point, the money circulates throughout the economy, and the only thing that happens in the longer scheme of things is all prices go up. Average price goes up. In the longer scheme of things, the price of coal relative to the price of wool remains unchanged. But the price of coal and the price of wool both have increased. Okay, which means that when the people in the Scottish Islands compare wool versus coal, they produce as much as they would have before. Okay, not anymore, right? But in the short run, when they were making this comparison, right, they changed the production level, they decided to make investments. Some of the investments was fixed and it cannot be reused. It's a real problem if you start making investments which are sticky in some senses. If you build a factory with equipments which can be readily put into some other use, no problem. But if you start making a factory with equipments which are so specific that it can be only used for the production of a particular good, right? And if the relative price of that good went up temporarily, which is what caused you to make these investments, once it goes down, you don't want to make them anymore, but that equipment no longer has much market value. That's where the real losses come. Okay.
Is there a difference between, this is different from the government making purchases with tax?
This is different from government. In fact, government doesn't gain anything from this. How much time do I have? 15 minutes. So one of the real sad bits about whatever I've just mentioned is that the government gains Nothing from this. Nobody, people don't gain anything. I'll come to you, Akash. People don't gain anything from this. Government doesn't gain anything from this. This is what economists would call deadweight loss. Okay, the loss of one person is not the gain of another, right? So when the government prints money and you lose resources and government has resources, by which you also have resources, because ultimately you are the government. People make governments, right? So either it's a bureaucrat, so the bureaucrats are spending on something, or somebody is cutting a new school. That's just one group of people losing resources and another group of people getting resources. Or if you want to take the very poor people in India, right? They have just decided to be able to purchase less from the market or market mechanism and have more of their bundle of goods come from government mechanism. Okay, whatever I've just mentioned, nobody gains. It's a net loss. You've trained somebody to rear sheep for the next 10 years, but it doesn't make sense anymore to rear sheep. It's a net loss, what economists call a deadweight loss. Deadweight loss. Okay, right? One thing I want to say, and then I will open the floor to question, is one of the questions that's often asked is, why would an investor make this mistake? Wouldn't she know that prices are going to go back to what they were before? And if she knew that, she wouldn't make this mistake. And if she doesn't make this mistake, then inflation is not a problem. Okay. The only issue is that prices in the real economy move because of a wide variety of factors. People's preferences are always changing. New technology is perennially discovered. Entrepreneurs are discovering new technologies, new ways of doing things all the time. Okay. So there is a lot of flux that comes from changes in what are called real factors. It is very difficult for an individual investor to figure out whether the price change in the price of her good, by that I mean the price of goods she sells, or the price of inputs that she purchases, has come about because of changes in real factors which are going to remain sustained in the future, or temporary monetary injections or extractions. It's not trivial at all. Okay, in a world with only, so there are some economic models which are populated with only one individual. Then of course it's easy. You're the only person, and the other person you have to deal with is the central bank. Everything is very clear. Millions of people related to each other through complex networks, production chains, long supply chains. It's very, very difficult to distill what changes in prices are happening because of monetary factors and what changes are happening because of real factors. Which is why entrepreneurs will tend to make these kind of mistakes, irrespective of how bright or intelligent they are. Right? It's not trivial at all to distill changes in prices, whole spectrum of prices that is happening because of real factors and monetary factors. So real cost of inflation is that it damages the, or it sort of throws sand into the signaling mechanism of prices. The price signaling mechanism is key to getting all of us to work together to produce goods and services in the global economy. Right? And what inflation does, it introduces noise into that signaling mechanism, and that is the cost of inflation. It's not the fact that, you know, goods have become more expensive. Not at all. In fact, you should keep telling people who tell you goods have become more expensive, it's become more expensive because of you. Because these are the same people who go to the, you know, electoral rallies and say, whenever a politician says free education, they are, yeah, we want free education. Sure, free education, less food. Right? I'll give that to you. Of course, a politician doesn't tell you that. But whenever they promise free education without you know, saying that I'm going to raise taxes or I'm going to borrow more, that's essentially what they're going to do. Okay, right? So that's the real cost of inflation. But let me now open up. There are several questions. You know, I'll maybe go in this order. I'll get you first.
Just to get sense of what would be the weight if you had to assign it on the real factors that affect prices, or the ones which are not really made up by people and exchanges. Just to understand what is the scale of the distortion.
It's scale. So very good question. In fact, I have a grant to work on this question, and they wrote to me last week saying, you know, how far has it gotten? Not too far so far. So I need to ask them for a year's extension. What's your name? So Saurabh, unfortunately, the people at the top schools in economics really haven't worked on this question. Part of the reason is that if you stuck to the aggregate kind of mindset that's there in the quantity theory of money, right? You don't really ask about how much do prices get distorted because of monetary shocks or monetary injections. There are some people at some top schools who have worked on this. One particular person is Emi Nakamura, and you know, her husband Stenson. Right? They look at extensive American data and they say that distortion is very little. I don't tend to agree with them. which is why I had applied for this grant and began this work. But um, this is sort of a frontier question, unfortunately a frontier question in economics. It should not have been. A frontier question means very few people have worked on it, typically, right? Or either the question is so difficult that it's not been resolved, or the question is resolvable but few people have worked on it. In this case, I think it's the latter. So if you write to me after 2 years, I might have something to say, at best. The grant people want it in a year, but let us see how it goes. Huh?
Maybe with the recording off.
It's a recording within, that's the problem. There's, I would say, sizable. So, I would say sizable. By that, I'm not saying anything new. It's only because I feel it's sizable that I'm giving this talk. It's only because I feel it's sizable that I, what's it called? That I applied for this research grant. Let me actually kind of say this. Suppose it takes off 0.5% of economic growth. Suppose a country which is growing at 2% could have grown at 2.5% had there been no inflation. Right? Now that 0.5 percentage point compounded over 50 or 100 years, that's sizable. Right? Did I answer your question and not answer your question? Let us hope so. But I think I would say it's sizable. Now, if you ask Emi Nakamura, their numbers are very close to zero. The problem is I don't think they look at this in a sufficiently rich manner. The reason I disagree with them is not about the number itself, but the fact that they don't have a view of an economy. So my view of the economy is the following, right? In the US, there are 6 million firms. In India, I think there are about 50 million firms. 6 million firms with employees, 20 million sole proprietorships. In India, I hear there are about 50 million firms. All these firms are related to each other in a supply chain, or what economists call a production network, right? So it's this large network that's getting distorted. Right? When prices change, you're deciding to buy more of this and less of that. You're trying to invest in some fixed equipment here, fixed equipment or not. Right? So distortion through this percolation of money through this large network can create distortions which will not be seen if your theoretical model is not sufficiently rich. It's very important to understand some of these things. What really matters is the theoretical lens that you take to view the real world. Right? Sometimes it may be there in the data, but depends on if your theoretical lens doesn't give enough space for the data to speak or to speak in a particular manner, you will kill it. You will not see enough effect. But again, unfortunately, beyond that, the Emi Nakamura paper is published in the Quarterly Journal of Economics about 3 years ago, called The Elusive Cost of Inflation. 4 years ago, I think. Elusive Cost of Inflation. Right? But again, one thing you will see is that they don't say that inflation is costly because things are getting more expensive. No economist would say that. Okay. So first thing I want you to take away from this lecture is that's not why inflation is a problem. It's a problem because it causes deadweight losses. It damages the economy. The real debate is how much is the damage, and what is the model that you use to assess how much the damage is, right? So Kumar, unfortunately, libertarians don't seem to be too keen on funding me to do this research. I don't know. Maybe that can change. Huh? Well, let me go. Akash has had hand up for a while.
I think just wanted to clarify this, because when you said deadweight loss,
Yeah.
I think what correct me if I'm wrong.
Yeah.
Is that when inflation is there,
Yeah.
when there is inflation, central bank prints more money.
Yeah.
That money, in most cases, lands up in some industries first, and then goes to other industries.
Yes.
So what that does, and if I'm wrong, just correct, is that there are some people who gain, there are some people who lose.
Yes.
But the loss is much higher than what the one group has gained. And then
that's a part of the story. That's a part of the story. But as the money percolates through the economy, that's a part. There are distributional consequences. So when we say, for instance, 0.5 percentage point may be taken off of economic growth, it doesn't mean that everybody loses equally. It's possible even the longer scheme of things is the money has a particular specific channel of percolation. It goes from the central bank. There are brokers that buy treasury bills or Government of India bonds. Those brokers have accounts in certain big banks. Those banks have then lent the money to certain companies. So these people who get the money in the first round, they get it before prices have gone up. they're able to purchase goods at old prices. As they purchase, the price of goods goes up, right? The people who get the money at the very end, they are the ones who lose most. So there are distributional effects as well, right? And it's possible that half a percentage point is in general, but despite that, there are some people who benefit from persistent inflation. It's well possible. But again, this area is so under researched. It's very difficult to say.
So, do poor people lose out because of inflation?
Poor would definitely. They would be they would lose out on two counts. In aggregate, if half a percentage point is going, the poor would lose out even more because they are the last to get the money. That is for sure. So, in fact, again, there is the research on the inequality and inflation, right? Again, is very little, and it looks at it's very naive. The research on inequality and inflation is things like poor people save most of their money. Their money is in cash or other holdings that are not inflation hedged. Rich people, they keep their savings in stock market, which is inflation hedged, or interest rates which are hedged to inflation. So they are not going to lose because of inflation. No, but there are much stronger effects. The stuff that Akash is talking about, the effects, my impression is again, my impression is, there is no research aside this, is much stronger. And if the libertarians want to kind of fund me, I'm happy to, give me $1 million and, I don't know. Right? And, 2 minutes to go? No way! So, your boss has a question. My boss has a question. What do you want me to do? Do you want me to lose my job? What do you want? Well, can I take his question and then go on?
I mean, it's with regards to Akash's question, but can't we say that sometimes even if I am from an industry which is getting a lot of government support, I also suffer? Because so what I observed was, so I went to a startup incubator and I saw that about 25% of companies there were working on some kind of electronic vehicle because government was giving a lot of grant into it. So because of that grant, yeah, they did gain in short run, yeah, they got some money to work on, but now we realize that no one is buying electronic vehicles
because you engage in production of goods and services which would not be produced in a general equilibrium defined by the preferences and technologies.
So that's a fiscal distortion.
Because of fiscal distortion. And in fact, so the monetary distortion story I said, and Akash is absolutely right, you can also make a story about fiscal distortion. Government comes up with a new program temporarily for kicks and giggles. You guys walk in, make sure, I'm not saying don't exploit that program, which you would anyways, right, irrespective of what I say. But don't make fixed capital investments, particularly capital which is sticky, right? Making capital equipment which would have little value except for the production of those specific goods and services, when you're doing it for a government program, may not be the wisest thing to do because the program may or may not last.
But that's why I asked if there's a difference between this distortion with tax.
There are possibly differences between fiscal and monetary distortions. That would be a topic of dissertation. That would be a 5-year-long study of why that is happening. This is what I always hoped comes out of such programs. People start dedicating their lifetimes to studying such things, writing about it, understanding at the highest levels, right? And maybe other people start funding such stuff, right? Kumar, you have $1 million to give me. Yes. Akash said?
Programs like NREGA,
Yeah.
where the money directly goes to the hands of poor people first. Would you then say that and through direct benefit transfer, cash transfers, then the negative inflationary impact is less on poor and more on
Yeah. It's tricky, right?
There's more government expenditure increasingly done through DVD.
So, I was only looking at the monetary side of how money goes. So there is a market for government bonds, right? Reserve Bank of India would, purchase government bonds, put the money. That money goes to the bondholders' account, which is in certain banks, and then it percolates into the economy. The NREGA stuff, you're right, it directly goes to the poor. But again, question is, whatever is being produced, does it reflect the real preferences of people? Right? It's not very clear to me. Maybe yes, maybe no. Of course, the inequality effects would be different, right? Because it's directly going to the poor. But the growth effects, it's not very clear to me. It's all kind of involved, murky, messy. One thing I can say is there aren't enough people asking this question. I think changing that would be very helpful to in detail study exactly, what is going on. NREG, again, assets are being built. It's not very clear to me how the decision is made as to what kind of assets should be built. right? Do they reflect the preferences of people? Is it going to be more the story of these temporary assets that are kind of built because of a program? Once the program is withdrawn, will the local communities have an interest in maintaining the asset because they really like the asset, it's something that they value and therefore they will continue maintaining it? Or is it just a reflection of the flow of funds happening? And it's not very clear to me. But you have a question.
My question was also similar to what Kumar said. But my example is something different. Like, the education one, the example we gave, like, people demanding free education. And what if government, DBTs to the parents, like, go and have free education, but the money would come on me. So would that be like less viable, or
So now,
because education is also producing something?
yeah, absolutely. So if you give direct bank transfers, so again, so the question that's being asked by Avinash, it's a very important question, right? Is suppose there is a demand in the electoral cycle, right? And people say we want free education. Of course, no politician tells them that there is no way to give you free education. Someone will have to pay for it. And since government is maxed out on taxes and also borrowing, right? We'll have to print money. No politician would say that. Right. Now, suppose instead of government schools, you get direct bank transfers and the education is produced by a private sector. Well, of course, you will get very efficient production of education. So the number of bricks, school teachers, water pipes, whatever is used would be used very efficiently and minimally and very well. That's nearly guaranteed if not just by a private system, but a contestable and competitive private system. Right. But you would still have all the monetary distortionary effects because you're not paying for it through taxes or borrowing, preferably taxes, right? Borrowings are anyways, should always be temporary unless you're building capital, right? In your own life, you can borrow to pay for your education because you're building human capital, which will pay for itself later. So unless you're building capital, right, or some temporary effect like ill health, right, you should be using present revenue. So the monetary effects will still be there. Now, how sizable are, so for here is an interesting question, Avinash. Take the best social expenditure that we might all, not Chris, but rest of us would agree on, right? So let's say bank transfer for education or bank transfer for health, right? Now, suppose that knocks out 1/4 percentage point of GDP because of the distortion, because you're not paying it by taxes, you're paying it by printing money. Would the same people be better off without that expenditure? Because a 1/4 percentage point GDP growth every year in 30 years might benefit them a lot. So what is the cost that they are paying or we are paying as a society as a whole for this? It's never just the taxes that is paid by the rich or the middle class or whatever, but it's the fact that everybody has become poorer because of monetary injections. It all goes back to the question that the person there was asking, how large are these effects? Not very clear. We can stop whenever you want.
So it's time already. I'll check if Parth is available. In the meantime, you can continue with Q&A.
Yeah, sure.
Like, there are different types of money supply, like M1, M2.
Yeah.
So how do the effects of inflation depend on the quantities of different types of money? How much proportion is M1, how much?
Yeah, all those get into sort of hairy areas, right? So okay, so there are many definitions of money, and so one definition of money is notes and coins in circulation. That's what we did in the last lecture. Then in some definition of money, bank accounts can be savings accounts, or what in the US are called checking accounts and what in India are called savings accounts. Anything that you can use to make a transaction. Okay. Then there is a bigger definition of money, time deposits, because time deposit typically you cannot make use for transaction, but you can break it and then use it for transaction also, right? And then the whole story that we told earlier becomes more complicated, but I'm not sure it gives us more insights into the substantial questions that we were looking into. Right? That's my understanding. Maybe one more question, then we can close, and then I'm available for casual chat. Yeah.
So, in that equation, I would like to go back.
Yeah.
So, velocity. Suppose there was a shock on velocity for something.
Sure. Whatever reason.
UPA is there.
Whatever reason. Yeah.
It doesn't exist and it exists.
Yeah.
Would that have very large? Wouldn't that be?
Yeah. So.
I mean, generally, it happens very slowly, right?
No, it's tricky. Okay, so to answer your question, if there is a shock to velocity, it will affect the price level. But your shock to velocity comes from something which is even more fundamental, because a change in what is money itself, which goes back to your question of what is money. So the m also changes and the v changes. So the whole equation needs to be rethought then. Yeah, it's much more fundamental, right? I'll tell you another thing about velocity. Velocity tends to drop during depression, recessions, and tends to, so there is a cyclical change in velocity, right? And then there is a long-term pattern. The slow decline, whatever I was mentioning about, or slow increase, it's a long-term pattern, right? The short-term pattern is during recessions and depressions, it tends to go down. During boom periods, it tends to go on. By the way, you should all read Robert Lucas's Nobel lecture. Robert Lucas, R-O-B-E-R-T, Robert Lucas, L-U-C-A-S. Akash, of course, has read it. Have you read it, Akash, after all these years?
I'm just wondering whether it's the same one on economic growth.
No, his Nobel lecture is on basically, it's called monetary neutrality, non-neutrality, but it's on basically inflation and money. Okay, so he begins by saying that, you know, when I was a young boy, I decided to study monetary economics because I didn't understand much, and now I still don't understand many things, but here are some things I understand. Okay, though I feel he understood a little bit less than what he thought he understood, but still it's worth reading. Okay, and there are some nice plots there of inflation across countries over long periods of time, and you will see that money supply growth and price level growth, you know, coincide very nicely across some, you know, I think 3 or 4 dozen countries over 3 or 4 decades. Okay.
There was a chart for during COVID, right? Inflation chart, and it was the correlation between the money supply and price level, and it was very nicely correlated.
Yeah, so you read Lucas's lecture. It's a Nobel lecture. It's a very good one. Okay, perhaps somewhat less insightful than he thought, but certainly much more insightful than much else that you can read. Okay, good. So thank you very much, and let us close, and then I'm available for discussion.